Hello, and welcome back to MoneyMasterMind. Today, we are exploring which retirement option is best for you. Now, let's get started. But first, if you enjoy this content or anything related to investing, be sure to like and subscribe for more videos like this. Now, let's get straight into it. The idea of early retirement and financial independence has gained significant traction in recent years. Early retirement symbolizes the freedom to pursue passions, travel the world, or simply enjoy more time with loved ones while still in the prime of life. It represents freedom from the constraints of a 9-to-5 grind and the opportunity to design a life on your own terms. However, achieving early retirement requires careful planning and strategic decision-making, particularly in the world of finance. This is where smart investment strategies come into play. While earning a high income is undeniably advantageous, it's ultimately what you do with that income that determines your ability to retire early. Smart investing involves making informed decisions about where to allocate your money, taking into account factors such as risk tolerance, time horizon, and long-term financial goals. In this video, we'll explore the critical role that smart investment strategies play in achieving early retirement and financial independence. By understanding the principles of effective investing and leveraging the right tools and vehicles, you can set yourself on a path towards financial freedom at an earlier stage in life than you may have previously thought possible. Join us as we unlock the key to a future of abundance, flexibility, and autonomy through wise financial planning and savvy investment practices. Retirement accounts are essential tools in building a secure financial future, and familiarizing oneself with their functions is crucial for effective retirement planning. 4 key types of retirement accounts include the 401k, IRA, Roth 401k/IRA, and 403b accounts. The 401k is perhaps the most common retirement account, typically offered by employers as part of a benefits package. It allows you to contribute a portion of your pre-tax income, with contributions often matched by the employer up to a certain percentage. The traditional IRA, on the other hand, is available to individuals who don't have access to an employer-sponsored plan. Contributions to traditional IRAs may be tax deductible, providing potential tax savings in the present, but withdrawals are taxed as ordinary income in retirement. Roth 401k and IRA accounts offer a different tax advantage. While contributions are made with after-tax dollars, withdrawals in retirement are tax-free, including any investment gains accrued over time. This can be particularly advantageous for individuals who anticipate being in a higher tax bracket during retirement. Lastly, the 403b account is similar to a 401k, but is typically offered to employees of nonprofit organizations, schools, and certain governmental organizations. When comparing these accounts, several factors come into play. Contribution limits vary between account types, with 401k and 403b plans typically offering higher contribution limits than IRAs. Also, each account type has its own set of rules regarding eligibility, withdrawal penalties, and required minimum distributions in retirement. By understanding the differences between these retirement accounts, you can make informed decisions about where to allocate your retirement savings, maximizing tax advantages and optimizing long-term growth potential. Contributing to a 401k plan can be a powerful strategy for building a secure retirement nest egg, particularly when considering the benefits it offers, especially if your employer provides matching contributions. One of the most significant advantages of a 401k plan is the potential for employer matching contributions. When employers match a percentage of your contributions, it's essentially free money added to your retirement savings, instantly boosting your account balance and accelerating your path to retirement readiness. To make the most of your 401k plan, there are several strategies you can use to maximize your contributions. Firstly, consider gradually increasing your contributions over time. Starting with a modest percentage of your income and gradually bumping it up each year can make a significant difference in your long-term savings without causing unnecessary strain on your budget. Also, individuals aged 50 and older have the option to make catch-up contributions to their 401k plans. These additional contributions allow older you to turbocharge your retirement savings in the years leading up to retirement. taking advantage of higher contribution limits and potential tax benefits. Another effective strategy is to contribute at least enough to your 401k to receive the maximum employer match. Failing to do so is essentially leaving free money on the table. By contributing at least up to the employer match threshold, you're not only maximizing your contributions, but also maximizing the benefits offered by your employer's retirement plan. In summary, maximizing your 401k contributions involves taking advantage of employer matching contributions, gradually increasing your contributions over time, making catch-up contributions if eligible, and ensuring you contribute enough to receive the full employer match. By implementing these strategies, you can supercharge your retirement savings and set yourself up for a financially secure future. Traditional and Roth individual retirement accounts offer distinct advantages, each catering to different financial goals and circumstances. Understanding these differences is key to making informed decisions about retirement savings. Traditional IRAs provide immediate tax benefits, allowing individuals to deduct contributions from their taxable income, potentially reducing their tax liability in the current year. This can be advantageous for those seeking to lower their taxable income while saving for retirement. Also, earnings within a traditional IRA grow tax deferred until withdrawal, potentially allowing for greater accumulation of wealth over time. On the other hand, Roth IRAs offer tax benefits in retirement rather than upfront. Contributions to Roth IRAs are made with after-tax dollars, meaning withdrawals in retirement, including both contributions and earnings, are typically tax-free. This can be particularly advantageous for individuals expecting to be in a higher tax bracket during retirement, or those seeking tax diversification in their retirement portfolio. When considering eligibility and contribution limits, it's important to note that both traditional and Roth IRAs have income restrictions. These limitations may affect your ability to contribute directly to a Roth IRA or deduct contributions to a traditional IRA, depending on your income level and filing status. Contribution limits for both types of IRAs are subject to annual adjustments by the IRS. Also, the tax treatment of contributions and withdrawals differs between traditional and Roth IRAs. Contributions to traditional IRAs are tax deductible, while withdrawals in retirement are taxed as ordinary income. In contrast, Roth IRA contributions are made with after-tax dollars, and qualified withdrawals in retirement are tax-free, providing tax-free growth potential over time. In summary, traditional and Roth IRAs offer unique tax advantages and flexibility, catering to individuals with varying financial situations and retirement goals. By understanding the differences between these retirement accounts, you can make informed decisions about how to optimize your retirement savings strategy. Roth accounts, including Roth 401, KETs, and IRAs, offer a unique set of advantages that can significantly enhance retirement saving strategies. One of the most compelling benefits of Roth accounts is the ability to make tax-free withdrawals in retirement. Unlike traditional retirement accounts where contributions are tax-deductible, but withdrawals are taxed as ordinary income, Roth accounts allow you to withdraw both contributions and earnings tax-free in retirement, provided certain conditions are met. Roth 401k and IRA contributions can also complement traditional retirement accounts by providing tax diversification in retirement income. By having a mix of tax-deferred and tax-free retirement savings, you can strategically manage your tax liabilities in retirement. This flexibility allows you to adapt to changing tax laws and personal financial circumstances, potentially minimizing your overall tax burden and maximizing your after-tax income in retirement. Individuals who expect to be in a higher tax bracket during retirement or anticipate significant future earnings growth may benefit most from using Roth accounts. For younger individuals or those early in their careers, Roth contributions can be particularly advantageous, as they have more time for their investments to grow tax-free. Roth accounts may appeal to individuals who value the peace of mind that comes with knowing their retirement withdrawals won't be subject to potentially higher future tax rates. In summary, the power of Roth 401k and IRA accounts lies in their ability to provide tax-free withdrawals in retirement, offer tax diversification, and cater to individuals with varying financial situations and retirement goals. By incorporating Roth contributions into your retirement savings strategy, you can improve your financial flexibility and pursue a more tax-efficient retirement income plan. Achieving early retirement requires more than just saving diligently. It demands a strategic approach to investing that maximizes growth potential while minimizing unnecessary risks. Tailoring investment strategies for early retirement involves several key principles, including asset allocation, diversification, and risk management. Asset allocation is a fundamental strategy that involves spreading investments across different asset classes, such as stocks, bonds, and cash equivalents, based on your risk tolerance and investment goals. Diversification within each asset class further mitigates risk by spreading investments across various industries, sectors, and geographic regions. By diversifying, you reduce the impact of market volatility on your portfolios and improve long-term stability. While seeking higher returns may be tempting, it's essential to avoid unnecessary risks that could jeopardize financial security. Maintaining a disciplined investment approach and sticking to a well-defined investment plan can help you weather market fluctuations and stay on track towards your retirement goals. Index funds, ETFs, and other low-cost investment options play a crucial role in building a diversified portfolio for early retirement. These investment vehicles offer broad exposure to entire market segments or asset classes at a fraction of the cost of actively managed funds. With low expense ratios and minimal turnover, index funds and ETFs provide efficient and cost-effective ways to achieve diversification and capture market returns over the long term. In summary, investment strategies for early retirement require careful consideration of asset allocation, diversification, and risk management. By adopting a long-term perspective, avoiding unnecessary risks, and utilizing low-cost investment options, you can build a strong portfolio that supports your goals of achieving financial independence and retiring early. A 403(b) account is a retirement savings plan typically offered to employees of certain tax-exempt organizations such as public schools, hospitals, and nonprofit organizations. Similar to a 401k plan, a 403(b) allows employees to make pre-tax contributions to their retirement savings, with contributions deducted directly from their paycheck. These contributions grow tax-deferred until withdrawal in retirement. Eligibility to contribute to a 403(b) plan is typically restricted to employees of qualifying organizations, including public school, employees, healthcare professionals, ministers, and certain nonprofit workers. Some 403(b) plans may allow for employer contributions, such as matching contributions or employer-funded contributions, further boosting retirement savings. While both 401k and 403(b) plans share similarities as employer-sponsored retirement savings vehicles, there are some key differences to note. One notable distinction is that 403(b) plans are generally offered by tax-exempt organizations, while 401k plans are typically offered by for-profit companies. 403(b) plans may have different contribution limits and catch-up provisions compared to 401k plans, depending on the employer and plan specifics. To maximize contributions and make informed investment choices within a 403(b) plan, you should consider several strategies. Firstly, take advantage of any employer matching contributions if available, as this is essentially free money added to your retirement savings. Also consider contributing the maximum allowable amount to your 403(b) plan each year to maximize tax-deferred growth potential. Carefully evaluate investment options within the 403(b) plan, considering factors such as fees, performance history, and asset allocation. Many 403(b) plans offer a variety of investment options, including mutual funds, annuities, and target date funds. By diversifying investments and periodically reviewing and adjusting your portfolio, you can optimize your retirement savings strategy within a 403(b) plan. Planning for retirement is a crucial step towards achieving financial security and independence in the later stages of life. A personalized retirement plan should begin with a thorough assessment of financial goals, risk tolerance, and time horizon. By understanding individual goals, whether it's early retirement, travel, or leaving a legacy, you can tailor your savings and investment strategies accordingly. Assessing risk tolerance helps determine the appropriate asset allocation, balancing growth potential with the need for stability. Also, considering the time horizon until retirement allows for appropriate planning and adjustment of investment strategies to meet long-term objectives. Periodically reviewing and adjusting the retirement plan is essential as circumstances change over time. Life events, changes in income, and market changes can all impact retirement savings goals. Regular reviews allow you to make necessary adjustments to your savings and investment strategies to stay on track towards achieving your retirement objectives. Online retirement calculators, budgeting tools, and financial planning websites can offer valuable insights into retirement savings goals, investment options, and potential strategies for maximizing retirement income. We also encourage you to seek guidance from financial professionals, such as certified financial planners or retirement advisors, who can provide personalized advice and support in developing and implementing a comprehensive retirement plan. In summary, creating a retirement plan involves assessing financial goals, risk tolerance, and time horizon, periodically reviewing and adjusting the plan as circumstances change, and utilizing resources and tools to plan effectively. By taking proactive steps towards retirement planning, you can work towards achieving your long-term financial goals and enjoying a financially secure retirement. In conclusion, this video has highlighted essential investment strategies and retirement planning principles to help you achieve early retirement and financial independence. We discussed the significance of understanding various retirement accounts, such as 401k, IRA, Roth 401k and IRA, and 403b, and how they can be used to maximize savings and tax benefits. We emphasize the importance of maximizing contributions to retirement accounts, taking advantage of employer matches, and gradually increasing contributions over time. We also explored the benefits of Roth accounts for tax-free withdrawals in retirement, and the role of index funds, ETFs, and low-cost investment options in building a diversified portfolio. Regularly reviewing and adjusting the retirement plan as circumstances change is essential to staying on track towards achieving retirement objectives. In closing, early planning and disciplined saving investing are key to realizing the dream of early retirement and financial independence. By taking action and implementing the investment strategies discussed in this video, you set yourself on a path towards a secure and prosperous retirement. Start today and take control of your financial future. Your retirement goals are within reach with careful planning and strategic investing. Thanks for watching Money Mastermind. If you enjoyed this video, be sure to check out our other videos for more investing tips. Don't forget to like and subscribe to stay updated on all our latest videos, and we'll see you in the next one.